Are you wondering how much house you can actually afford? Well, you got to be careful with those lenders' pre-approvals because if you stick strictly by those, you can get in trouble. I'm going to go over today how much house you can really afford without having buyer's remorse. So stick with me. Hi, I'm Emmanuel. Welcome to If I Can, You Can, the channel where if I can do it, you can do it too. I go over real estate investing and home renovations. As always, if you like this content, please like and subscribe below. I always want to hear what you have to say, but today I'm going to be going over how much house you can really afford. A general rule that lenders will take when they look at your affordability is going to be the 28-36 rule. That means 28% of your income should be able to go to your house. That's going to include your insurance, your taxes, your mortgage itself, any interest you have on the loan, all that should be rolled up into your home loan. And that's no more than 28% of your gross income. Next is the 36% rule. The 36% rule is of all your other debts in combination with the housing debt too. So if you have anything else on top of that, will be like student loans, credit card debt, a car payment, a personal loan somewhere. All that should not be more than 36% of your gross income when it's combined with the house that you're looking to buy. For example, if you have an income gross of $6,000 a month, you should be buying something that's no more than $1,680 a month in total when you're looking at the 28% rule. And there's many factors that people forget when they go to buy a house. I know I forgot many of them when I did. One will be property taxes. When you pay property taxes, those vary year to year. They can go up, rarely will go down, but they can vary thousands of dollars per year, which means hundreds of dollars per month. Also, homeowners insurance. If there's been a lot of claims in the area, homeowners insurance may go up too. Same thing with HOA fees. That could be anywhere between $50 and excess of $500 a month just for HOA fees. Then there's utilities and landscaping. You have to pay for utilities of an entire home versus a single room or a couple rooms of an apartment. And then you're going to have your repairs and maintenance, which could be between 1 to 3% of the property value when you bought it. Is that an accurate assessment? Not really. Some years you may have nothing. Some years you may have an AC go out. So it's kind of the average. Then lastly, closing costs when you go to close on the property. That's one thing I completely forgot about. I thought it was just their down payment and then going straight into getting the house. That closing cost can sneak up on you. It can be thousands of dollars, if not into tens of thousands of dollars, depending on several factors. My suggestion is to get to know your affordability a lot closer. You should use an affordability calculator. Now, there's several places out there that have calculators that you can plug into. Some examples are Bakerate, NerdWallet, Zillow. These are a couple ones I use. They work fairly well, and I think they're really good to help people when they're getting into this. They'll have you plug in things like your income, your debt, your down payment, your interest rate, your loan term, and your expenses. And then it'll tell you on the back end if it's a good fit for you. And remember, your comfort level of what you want to be able to afford may not be the same as your bank. Your bank may look at you and say, hey, you can afford up to $700,000. When in reality, you may only feel comfortable for something that's $500,000. It really depends on what you're comfortable with. The other things you need to keep in consideration are your down payments. If you have a down payment of 5, 10, or 3.5%, depending on your loan type, it's going to be a lower upfront cost, but it's going to kick you in the teeth going down into the future with your PMI payment. That's your property mortgage insurance payment. That's going to be added onto your bill every year, every month. And those add up over time. You can also avoid this if you put down 20% towards your home loan, but that's a higher upfront cost and very significant when you compare it to a 3.5% or 5% down. Really, my final verdict on this is you should buy to your comfort level. That means when you have everything and you have a bottom line of what you think it may cost, you add in all those factors of HOA fees and how much it costs to fix stuff. If you don't feel comfortable with that, Nothing says that you have to buy that house. Buy something that's in the price range that you are comfortable with and you have enough flexibility in your budget to afford. Just because the bank will lend to you that much does not mean it's a good idea. That's all I have for right now. Heck, leave me your ideal price range in the comments below. I'd love to hear what you have to say. But for right now, that's all I have, and I'll see you in the next one.